I wanted to walk through the fourth week. What we do every single month is we do a cash flow forecast because it all comes down to timing. It's so important to make sure the timing of money coming in is matching when it goes out. Otherwise, we're going to go bankrupt or have a huge interest payment, or we're going to have to beg for money from somebody else or take it out of our own paycheck. So what we do is we start with an overhead calculator. This is done every 3 months or 6 months, depending on how much things change. But this is a client of ours. We went through and we figured out, and this client told me, hey, I do 5.5 million last year and I don't have much overhead. So we started going through, and he leases his own property's building, but he still has to pay that money. So that's money out according to the bank. We look at his utilities, they're all in there. We start to look at his project management softwares, QuickBooks Enterprise, that's $350. We keep going, and he has somebody doing some maintenance for his IT, so his field labor can access everything in his shared drive, and he has somebody managing all of that. Payroll services for his certified payroll. His accounting, bookkeeping person, basically his CPA that does bookkeeping for him. We were looking at his employee payroll taxes. They hit every week, whereas this column hits every month. We saw he was going to a job site every single day, and by the end of the week, he spent $650 on gas just right there that he wasn't job costing. We started looking down and we see general liability insurance, workers' comp, vehicle insurance. It all adds up. So what we came up with is he had $619,000 in overhead. And when he did $5.6 million last year, he actually was spending 11% on overhead. So traditionally, a construction company wants to be at 10% because that's what you're limited to in the contract. So at 11, if he signs a contract that says on any change orders, you're only allowed to make 10% overhead and 5% profit, this is already eating into that little bit of profit if you get your change order right. Now if it's time and material, he's guaranteed a loss. So this overhead should match a $6.2 million a year company. So all of that calculates, and we started to look at his 12-week forecast. We started with what's in the bank, what do we have over here for money coming in on different projects. He had one massive project, so we were cash flowing that. We have all of his overhead requirements. He didn't have any expenses he wanted to play with, but I will use this and see, can we hire that person? How much can we afford? When can we afford it? And that could be an estimator, a project manager, somebody on the crew, whoever. We saw his labor was $15,000. Just he has a crew that he has to keep busy, so he pays that every week, no matter what, like clockwork, assuming everybody's coming in. If somebody doesn't come in, you might pay less. But then we started looking at his accounts payable. He had $30,000 for material. He had all these little ones hitting. And these little ones were because he was using mom and pop shops who didn't charge out, right? And he had some smaller concrete subcontractor vendors. So they're requesting payment weekly, and that helps him get a little bit better rate. He had some rental equipment he had to get to do something. We put on all of his debts that we're paying off. And what we came up with at the bottom was we have some months that are kind of a red flag. And you can see when we look at that here in week 5, if everything stays the same, we're going to start to have problems. And that's the first week of the next month. We see that same thing in month 3 and then toward the end of month 3. So what this helps us realize is, where do we have problems? When do we start to have them? We notice there's a pattern at the first, so we have to make sure we're collecting. And what this allows us to do, because he hadn't billed yet, we actually went in and we figured out, hey, we can actually bill $250,000. And that allowed him to keep going. We have this little bit of float here in week 5 and week 9. Well, this is where we put in his line of credit. We put in either an SBA loan. He works with build and mobilization funding. We considered using a little bit of both of those. And what that allows you to do is if you put a little bit of money from build, for example, when you get paid in month 4 on the next tab, then we pay it back as soon as we get the check, which we should be setting pretty good when we're billing $250,000 and we're planning ahead. But this allows us to not be so turbulent. When we start to plan and we start to look ahead, you won't feel cash flow anymore because it's understood. It's not a guess. It's not I hope. It's not I think. You don't have to pick who you're going to pay. You have it already dialed in. Who you're going to pay, when you're going to pay it, how much you're going to pay. And you let the spreadsheet tell you exactly. It's just math. It's money in minus money out plus a little bit more money in if you need to use a line of credit or a loan or something like that just to stay afloat. And these red cells are all calculated based on his money that he doesn't want to go below $25,000 or he starts to feel stressed. So it just flags for us when we need to do that. And so, for example, what I gave him as an action item is on week 2, week 3, we need to be calling about this $120,000 because if we don't collect it, we're going to have a major problem and we're going to have some stress from that. So, thanks, guys.